ECN listeners, this is your weekly FX market update brought to you by Rare ECN. First, in line with this discussion, this week's commentary will largely focus on the euro-dollar market. Last week, disappointing US non-farm payroll and unemployment print became the underlying reason for the single currency to rebound from weeks of consecutive decline against the greenback. Unlike last week, this week's volatility focus will be shifted from the greenback and back onto the single currency, with the market anticipating Mario Draghi's rhetorical during Tuesday ECB press conference. In addition to that, the US ISM non-manufacturing PMI will determine whether this week's greenback rally can be sustained or not. So first, in line with this commentary, we will focus the update on two components. The first component is the technical part of the commentary. After 2 trading weeks of bearish decline, the euro-dollar market managed to catch a break and rebounds from the 1.3380 level to the 1.3430 level on the back of a disappointing US non-farm payroll print and the degradation in the expectation of a rate hike by the Fed. What this entails is that this rebound has allowed the euro to rally from the 61.8% Fibonacci expansion marked by the 1.33950 level to trading slightly below the 50% expansion at 1.3450. So in accordance to the SSI, which is commonly known as the Speculative Sentiment Index, recent euro-dollar multi-week low has given retail traders the opportunity to pile onto long euro-US dollar position. Analysts would suggest taking the contrarian standpoint to this cross sentiment and expect further weakness in the single currency. At current price action, retail traders Euro-US dollar long interest sits at the ratio of 2-to-1 short interest outstanding. The next support tier that analysts are monitoring is the 1.33 mark, established by the November low, and failure to sustain trading momentum above this level will expose the pair to the 1.31 mark by the September peak. Analysis of a collection of technical indicators on the hourly time interval on the euro-dollar market is suggestive of a temporary bullish market sentiment and recommends long positions on the single currency. The euro-dollar cross opened today's Sydney trading session inching closer to the established Fibonacci support at 1.3421, while the Fibonacci resistance is set at 1.3429. Since last week's euro-dollar rally, the pair briefly broke above the 200-day simple moving average in the process. However, this trading momentum was not sustained, causing the single currency to trade below the 200-day simple moving average once again. Since the euro-dollar cross opened today's Sydney trading session below the 200-day simple moving average, this is very indicative of a long-term bearish outlook on the cross moving forward. This bearish standpoint is not validated on the short-term moving average front, however, as the pair opened today's trading session above the 5 and 10 but below the 20 and 30-day simple moving average, which is indicative of a whole recommendation on the moving average front. So moving along to the fundamental component of the euro-dollar market, without a doubt, last week's euro-dollar market has been tainted with a shift in market sentiment that favors the greenback on the back of rising US Treasury yield, coupled with a brief spark in risk aversion. The loss of risk appetite by investors was very reflective in the sell-off in the equity market during last week's trading session. Last Friday's trading session was the climax of last week's events, with retail investors entering into last week's Friday trading session with a weaker than expected German manufacturing PMI ticking in at 52.4 below a forecast of 52.9. However, the predominant Tier 1 market moving piece of data that was the US employment report. The US non-farm payroll print came in softer than what the market has been anticipating at 209,000 jobs when the market expects a 233,000 job reading. In addition to that, the US employment rose from 6.1% to 6.2%, and the average US hourly earning flattened, with expected a 0.2% expansion. In response to the disappointing U.S. employment report, long-term Treasury yield fell as the market repriced the expectation that the Fed would become more reluctant to engineer an exit strategy. The Fed's QE tapering program, will come into completion by October, and when September comes, the market are expecting an exit strategy by then. However, post the non-farm payroll report, most likely would the Fed remain accommodative until economic conditions improve. Last week, piece of positive economic data out from the US was the ISM manufacturing PMI, which beat expectation by coming in at 57.1 when expectations set at 56. Heading into this week's trading session post non-farm payroll, the only volatile piece of report that will affect the greenback price action is Tuesday US ISM non-manufacturing PMI forecast to read at 56.3 when the ISM non-manufacturing employment component is expected to expand at 54.4. So over in the Eurozone, the market can expect a string of Tier 1 leading economic report heading into this week's trading session. On Tuesday, the German will release its service PMI print forecast to come in at 56.6, while the Eurozone PMI is expected to tick in at 54.4. In addition to that, the Eurozone retail sale month-on-month is forecast to read at 0.4%. Meanwhile, on Thursday, the German will release the industrial production month-on-month print forecast to expand by 1.3%. The biggest highlight for this week's event is the ECB press conference, and the interest rate decision with the Eurozone benchmark rate is expected to remain unchanged at 0.15%. Nevertheless, the volatility will certainly stem from Mario Draghi rhetorical, with the understanding that the inflationary pressure will continue to be the Eurozone's biggest challenge. And the bank's rhetorical will most likely lean toward dovish, with additional plan of action for the implementation of further stimulus package. I want to thank all our listeners for spending the time with us and have a successful trading week, everybody.